Hey, what's up guys, it's Marcos. So here's something most homeowners don't realize. The difference between where you get your home equity line of credit could cost you thousands of dollars in interest, even if the rate looks almost the same. And right now in 2026, with home equity at near record highs, it is estimated that Americans have over $30 trillion in equity right now. Home equity lines of credits are also tied directly to the prime rate. And look, choosing the wrong lender is not just making a small mistake, especially when home equity lines of credits have become so popular, and it is one of the most important products that people use to tap the equity of their homes. So today, I'm gonna be breaking down credit unions versus banks versus online mortgage lenders and mortgage brokers who can actually give you the best deals on a home equity line of credit, where the hidden costs are going to be, and which one I would recommend you based on your own situation. Because at the end of the day, getting the lowest advertised interest rate, or at least looking for it, is not gonna be necessarily the best or the cheapest HELOC for you. Now, here's also what we're gonna cover: how home equity lines of credit's interest rates are actually priced, and trust me, most people misunderstand this. I'm also gonna tell you why the big banks can actually be a good play for getting a home equity line of credit. However, there is a universe out there where going with a national mortgage lender or a mortgage broker actually gives you the better options for getting a HELOC based on your situation. Let's start with the part that nobody explains, and that is how HELOC pricing really works. HELOC interest rates are made up of two things. You gotta understand this if you wanna know how HELOCs are actually priced in. You have the prime rate and you have the margin. Right now, the prime rate is sitting at roughly 6.75%. If you don't know what the prime rate is, it's really simple. It is basically an index that banks use for their most credit-worthy clients, such as credit cards, personal loans, and especially HELOCs use the prime rate. Now, the margin is really where the lender makes money. Every lender is gonna set their own margin based on your credit scores, your loan to value, which is basically how much equity you have. Also, your line size is gonna matter, and sometimes even the relationship you have with the institution. But very importantly, it's also gonna be the type of HELOC that you are doing. That margin is really where the difference shows up, not the prime rate, because at the end of the day, every lender is gonna use the same one. Now, here's something very important to understand to keep things in perspective. Just so you know, between 2020 and 2021, home equity lines of credit interest rates were in the 3 to 4% range. And then the Fed raised rates about 11 times to fight inflation, and as a result, HELOC rates double. Fed does not control HELOC interest rates. The Fed controls Fed funds rate, but the prime rate is based on the Fed fund rate. So when the Fed cuts or raises interest rates, HELOC rates will change as well. At the same time, homeowners have gained massive equity over the past 4 years. So we have high interest rates, high equity positions, and millions of homeowners looking to get flexible cash without the refinancing of their low fixed mortgages, which is exactly what's made HELOCs become one, if not the most popular loan for homeowners to tap into the equity of their homes. And by the way, you can use a HELOC for a lot of things. For example, most of my clients use HELOCs to debt consolidate. So if you got credit cards with a high APR, or personal loans with high interest rates and high payments, using a HELOC to pay them off is a great option. You can also use them to invest, and not only invest in the stock market, but also invest in other real estate. And then on top of it, you also have access to liquid cash anytime. And by the way, this is all without the need of refinancing. So now the key for you is to be able to find the right lender for your own personal situation, which is gonna take us to the first option, and that is gonna be going with a credit union, which typically they will have the lowest interest rate. Now, you're probably wondering yourself why credit unions will have the lowest interest rates. The reason why they have lower interest rates is because credit unions are typically nonprofit structure, and they do focus more on their members instead of trying to have bigger margins. When you go with a credit union, it is really common to see interest rates such as prime plus 0 margin, or prime plus 1 or even 2%. And sometimes you might even find introductory promos well below that. Now, here's gonna be a trade-off. When you go with a credit union, it's not going to be, roses and peaches, because it just won't be. You're gonna have to deal with slower processing times. Going with a credit union is like going with a bank. It's only gonna be bank hours 9 to 5. You won't be able to get a hold of a lot of people. It's gonna be really difficult to reach your loan officer or your loan processor. Just be aware that the process is going to be a little bit more cumbersome. Now, the other thing is also gonna be less flexibility for complex scenarios. And a lot of you guys who are watching this video might be self-employed, you might have multiple properties, or you might be looking for HELOCs on I don't know, maybe investment homes. Well, guess what? Credit unions are not necessarily going to be the best option for you because they're going to be very cookie cutter, very inside the box, and flexibility is not one thing that credit unions are known for. However, if you are a strong borrower with a 720 plus credit scores, a lot of equity in your home, so say maybe 50, 60% equity position, and probably a W-2 job with a salary, no self-employment, no multiple properties, then credit unions are probably gonna be the best pure interest rate play for you. Also have a lot of patience because you're gonna need it. Now, option number 2 is gonna be going with a big bank. So this is gonna be your middle ground. Think of companies like Wells Fargo, Bank of America, Chase Mortgage, Truist, PNC Bank, you name it. Now, big banks are typically gonna offer prime plus 0.5% to about 3% in margin. A lot of banks are going to be extremely competitive with home equity lines of credit. Now, the reason why banks will want to get your business for a home equity line of credit is because when people have a lot of equity in their homes, it also shows the bank that you might have different assets and they want to get your assets to come under management with them. But also banks are known for being actually pretty decent at doing home equity lines of credit. They have faster underwriting. They can also offer you larger credit lines. This is going to be really important for you if you are probably starting a business, you need a lot of capital, you got multi-million-dollar homes, and maybe doing a $200,000 credit line is not enough. But also, you may get access to relationship discounts, and sometimes they can be worth anywhere between 0.25% to 0.5% off of their margins. Historically, banks price home equity lines of credit heavily based on deposit relationship. So if you also have a lot of assets under management with a specific bank, then you might have access to lower interest rates compared to somebody walking off of the street. Obviously, when you do deal with banks, you are going to have a lot of downsides. For example, if you have complex income history, a complex situation, or questionable credit history, maybe you've had some late. This can be very frustrating, and a lot of people end up getting denied. And I've seen processes that take 3 to 5 months with a bank, and a lot of clients have found themselves just getting denied through an email. Now you've wasted all this time trying to get a home equity line of credit with a bank, but maybe you should have gone to option number 3, which is going with a national mortgage lender or a mortgage broker. These institutions are going to give you more speed, more flexibility, and mortgage lenders and brokers only deal with mortgages. So you're also going to have access to more different lines of credits, and even lines of credits that use different types of income documentation and even lower credit scores. So the flexibility is going to be there. However, the biggest disadvantage to getting a home equity line of credit through a mortgage broker or a mortgage lender is that the interest rates are going to be a little bit higher. Sometimes we see interest rates anywhere between prime plus 2% all the way to prime plus 5%. So yes, they will be a little bit higher compared to going with a credit union or going with a bank. But once again, a lot of people do choose going with a mortgage lender or a mortgage broker because you're going to get faster approvals. Sometimes it can only take just a few days to get your home equity line of credit approved. You're also going to be able to access higher loan to value limits. For example, going with a big bank like a Wells Fargo or Chase Mortgage, the maximum loan to value might be just 75 to 80%, but going with a mortgage broker, it might go all the way up to 90%. Also, there's going to be different income options, especially this is going to be important if you are self-employed, if you're an investor, you got multiple properties, and sometimes there are even home equity lines of credits for people with no income whatsoever. These things, you're not going to find them with a credit union or with a big bank. Now, finally, let's talk a little bit about the hidden cost and what most people miss. The first thing is home equity lines of credits are variable interest rate loans. So if the Fed cuts interest rates, your payment is going to go down. If inflation comes back again and the Fed raises interest rates again, guess what? The Fed funds rate is going to go up, which once again is going to make the prime rate go up, and your payment is going to go up. However, historically speaking, the prime rate has ranged anywhere between 3.25%, which was back in 2020 when interest rates were really low, all the way to about 8%, which was about 2024 and 2025 when interest rates were really high. So yes, it's been a massive swing, but the prime rate doesn't necessarily swing that drastically. Now let's talk a little bit about what fixed interest rates and variable interest rate HELOCs are. A lot of times you guys are going to find different lenders or institutions show you fixed rate HELOCs being advertised online or whatever. Don't get fooled by this, because fixed interest rate HELOCs kind of don't make any sense whatsoever. You're gonna end up paying for a much higher interest rate. And again, historically, they've always been set up to be in variable interest rates, and these are the true ones that actually make sense. So going with a fixed rate HELOC, you're probably gonna find lenders who offer them like maybe fixed for 1 year, fixed for 6 months, or 2 years, an interest rate that's gonna be fixed for the life of the home equity line of credit. And trust me, if you do find it, it's going to be extremely high. Now, if you're somebody who's extremely risk adverse and you don't really wanna deal with anything variable, then perhaps getting a HELOC is not gonna be the best option for you. Therefore, go instead with a home equity loan as a second mortgage. A home equity loan is gonna be more akin to a personal loan, which basically has a fixed monthly payment, a fixed interest rate. However, when you get a home equity loan, you get a lump sum of cash at closing, and you can go back and get more money like you can with a HELOC. That's why home equity lines of credits have become so popular. It's because they give you a ton of flexibility to come back and use more money later, just basically like using a credit card. And if maybe getting a home equity loan is also a little bit too much for you because now you're gonna be carrying 2 mortgages, then default and do a regular cash out refinance. At the end of the day, a refinance, although it will pay off your current first mortgage, and if you have a low interest rate, you're gonna forego that, low interest rate, but it's just gonna be 1 mortgage only, 1 monthly payment, and truth be told, it's gonna be the lowest interest rate that you're gonna be able to access from the equity out of your house. Now, finally, what are some of the closing costs that you can expect with a home equity line of credit? A lot of people think that getting a home equity line of credit is going to be just free. Nobody's gonna charge you anything. That's not true whatsoever, because at the end of the day, whether you go with a bank or a credit union, even if they say that they're gonna do it for free, nothing is free in life. You're gonna get charged something. In pretty much every state, you always will need a real estate attorney to do your closing. The thing is that whether you go with a credit union, a bank, or a mortgage lender, mortgage broker, they can add those fees into the line of credit. But to say that there are no fees when you get a line of credit, that's not necessarily true. The second thing that you need to be aware of when you get in a HELOC is that you will have to pay some annual fees, but don't worry, they're not gonna be outrageous. At the end of the day, getting a home equity line of credit, you should probably not spend any more than, say, $3,000 to $5,000 in fees. Now, before I forget, this last final thing is this is how home equity lines of credits work, and it's something that you need to keep in mind, especially if this is the first home equity line of credit that you're gonna end up doing on your home. You are gonna have what we call the draw period, meaning you have about 3 to 10 years to use the line of credit. If you go with a credit union or a bank, they're probably gonna offer you a 10-year draw. You're gonna have roughly anywhere between 20 to 30 years on repayment, meaning that you have that amount of time to pay it all back. But once your draw period is up, whether it's 3 years, 5 years, or 10 years, your lender is going to switch your whole entire payment into principal and interest fully amortized, which means that before your draw period comes up, you should be thinking about having that line of credit paid off in full. Otherwise, you can find yourself with a pretty big payment that you might not be ready for. Now, the big question, who actually has the best home equity line of credit? Here's the real answer, nobody does, okay? But if you're looking for the best interest rates, I will go with a credit union. However, keep in mind that you probably wanna have a very easy, complete file in order to go with a credit union. And same thing is gonna be with a bank. But if you have a complex situation, once again, you're self-employed, you got a different income sources, you get a lot of properties and stuff like that, then probably you wanna go with a national mortgage lender or a national mortgage broker. Guys, at the end of the day, using your home equity is a very smart decision if you have a strategy on what to use it with. Definitely don't spend it on doing stupid stuff like, booking flights, going on trips. Instead, make sure that you are using that equity for things that are gonna help you grow your wealth. If you guys have any questions about HELOCs or anything of this nature of how to tap into the equity of your home, make sure that you put those questions in the comments right down below. I'll make sure that I answer everybody, and I appreciate you guys watching this video. Just make sure that you follow as well, and I will see you guys on the next video. Thank you so much. Talk to you later.